Hello, thank you for joining me in the webinar today. My name is Louis Green. I'm a chartered financial analyst, certified financial planner, certified private wealth advisor. I wrote a book on retirement planning. That book can be downloaded for free at 5stepsToRetirement.com. If you have any questions or want a copy of the book over email, please email me, louis.green@savvyadvisors.com. You can call or text me, 917-590-0552. I'm happy to set up a complimentary consultation. Please feel free to share that information with friends, family, and coworkers. Let's get started. Here's the agenda for the webinar. I'll spend about 25 to 30 minutes presenting. I'll start with a brief introduction to my practice. I'll spend some time on the 5 topics in the book: financial planning, investment planning, tax planning, estate planning, lifestyle management. I'll wrap things up and tell you how to keep in touch. Please note, we do not provide legal or tax advice. Please reach out if you're looking for an accountant or attorney, as we have a network we might be able to share with you. Here's a brief introduction to my practice. My practice sits between financial planning and investment management. I believe that a comprehensive financial plan is the key to managing wealth. I pride myself on being easy to talk to. My approach partitions clients' assets based on their short, medium, and long-term goals to help keep them aligned with their personal financial situation. Growing up, I was inspired by my father, who was an accountant, and seeing the impact he made on his clients' lives. I earned my MBA, and I pursued further education, including the Chartered Financial Analyst, Certified Financial Planner, and Certified Private Wealth Advisor designations. Now, why does retirement planning matter? Well, in my opinion, there are 4 reasons. 1, the options can be confusing. 2, there's a trend towards self-managed retirement plans, meaning we have to do a lot of the work on our own these days. 3, we are living longer. And 4, just way too many of us are not prepared for retirement. Now, as you can see here, there are quite a number of options that might be available to you. Here are a few of those options. Not everyone's going to be eligible for each of these plans. Start with the 401k, the Roth 401k, the 403b, and the 457b. Those are employer-sponsored options that might be available to you depending on your employer type. There are self-funded options such as the IRA and the Roth IRA. Now, some of these options, such as the 401k, offer pre-tax contributions, tax-deferred growth, and taxes are paid on withdrawals. The Roth 401k offers after-tax contributions, tax-free growth, and no taxes on qualified withdrawals. The IRA is the same thing. If you're eligible to deduct the contributions, you're going to get deductible contributions, tax-free growth, and taxes are paid on withdrawals. The Roth IRA, again, if you're eligible, you're going to have after-tax contributions, tax-free growth, and no taxes on qualified withdrawals. When we work with our clients, not only do we educate them on each of these plans, but we make sure to align their investments with their retirement plans as well. And you should do the same. Now, as you can see here, there are 2 broad pension plans by type. There's the defined benefit plan. Well, that's the type of plan that's very nice to have if it's available to you. That's the plan that provides you with a set amount of money upon retirement on a monthly basis. And your employer is going to bear the risk of that plan. So as you can see here in the dotted lines, those plans are a far small portion of pension plans, the overall pension plans by type. And then there's the defined contribution plan. This is the type of plan where you're responsible for your contributions, you're responsible for your investments and your asset allocation. You can see here in the pink, that's the dominant type of plan now. So make sure to align your investments and be mindful of the pension plans. When we work with our clients, again, we align their investments with their pension plans by type. As you can see here, the message is clear. We are increasingly responsible for our own retirement. Now, as you can see here, our lifespans are only going to continue to grow. This is a study done by the UN. As you can see in that blue line, our lifespans are going to continue to grow and expand going forward. What does that mean for you? Well, that means your money needs to last for a longer time period. So be mindful of that. And we work with our clients. We build these expectations into their financial plans, and you should do the same. Many of us are not prepared for retirement. So I do some pro bono work for many recent divorcees, and I'm surprised to see that many of them don't have any financial plans or have done any financial planning at all. In fact, April 2024, an AARP study found that 61% of adults age 50 and older are concerned they won't have enough money to support themselves in retirement. That's a big problem and a very alarming figure. So we work with our clients. We do our best to prepare them for retirement, and you should do the same. Start early. Be mindful of your retirement every year. Revisit your plan. Let's move on to financial planning. Financial planning really is the blueprint for your retirement. I'll share an example, a sample financial plan as well, and provide some tips for you. Now, here are some of the items you should consider in your financial plan. Start with having a written financial plan. I'll share a summary of a financial plan in a couple of minutes, and set retirement goals as part of that plan. This is going to allow you to determine where you're at, where you need to be, and what steps you need to take to get to where you want to be. Create a budget, actually write a budget down and a savings plan that's going to provide you with discipline you need to set aside enough money each year. If you're saving every year, you might start to take advantage of what's called compounded interest, which is interest on interest over time. That can be very powerful for you going forward. Be mindful of your retirement accounts. I shared a couple of examples earlier. Do your best to maximize those contributions as long as that's within your risk tolerance. I'll share what a risk tolerance is in a couple of minutes. Address sequence risk. Sequence risk is the risk of a big market decline right before or right after you retire. Most people are concerned more with risk than anything else. It's a big concern for many people. We address sequence risk by creating goals-based portfolios for our clients. Address Social Security. So be mindful of different amounts you might be able to get monthly, depending on the age in which you claim Social Security, and have a plan for Social Security. Manage debt. If you have a high interest debt, be mindful of the impact of that debt on your retirement plan. I'll share an example in a couple of minutes as well. Consider having a sample financial plan. This is a summary financial plan from eMoney, which is software that we use and I work with some of our clients. As you can see here, it does a nice job of really breaking out the plan. You have your living expenses, current and in retirement. You have your different sources of income. You have your balance sheet, your assets, your liabilities, your net worth, the asset allocation, the equities and fixed income mix, as well as projected returns and risk. It also does a nice job of providing a probability of success. Now, again, you might not be able to do this with a plan that you have on paper, but there is software that you can purchase. And if you're working with an advisor, consider having them create a financial plan for you. Have a plan for Social Security. So be mindful of your monthly benefit based on your claiming age. So let's take a look at a sample client here. Let's say she received Social Security at the age of 66, so she could receive $1,000 a month. If she waited until the age of 70, she could receive $1,320 a month. That's a 32% increase. When we work with our clients, we help them optimize their Social Security. There's definitely software that we can use and the software that's available to you. But be mindful of the different benefits and coordinate your Social Security benefits with your living expenses, your financial situation overall. As you can see, it can make quite a difference on the income you receive each year. So have a plan for Social Security and open up an account with the Social Security as well. If you have a lot of debt, be mindful of the negative impact that debt might have on pursuing your retirement goals. Here we have two examples. We're looking at $15,000 credit card balance with a 20% interest rate. Example number one, clients paying $300 a month. Example number two, clients paying $600 a month. As you can see here in the top left, example number one, clients paying that debt off in 9 years and 1 month. Total interest paid is over $17,519. Example number two takes the client only 2 years and 9 months to pay off that debt. Total interest paid is a little over $4,500. So that's a big difference. That's money that can be better used to pursuing your retirement goals. Have a plan for your debt. When we work with our clients, we help them reduce their debt by having a plan for that debt as well. Withdrawal rates. So many of the clients that we meet with ask us to determine how long their portfolios might last after they retire. And they want to know what are some of the factors that might determine that. And we tell them asset allocation, market outlook, economic outlook, but also the amount of money you're withdrawing from that portfolio on an annual basis, aka your withdrawal rate. Here we have two sample portfolios. We're looking at 50-50 portfolios, meaning 50% stocks, 50% bonds. Portfolio number one in purple has a 4% withdrawal rate. Portfolio number two in orange has a 5% withdrawal rate. Both portfolios start at $1 million. As you can see here, the ending values are quite different. Portfolio number one, in which the client is withdrawing 4% per year, has an ending value of 1.571 million. Portfolio number two has an ending value of 991,000. So be mindful of your withdrawal rates when you're structuring your portfolio and when you're considering your retirement plan. And we do the same in our work with our clients. Let's move on to investment planning, balancing risk and return. I am a chartered financial analyst, so I spend a lot of time on investments with our clients, doing our best to create investment portfolios that are suitable for them. Now, here are some of the investment items we consider in our work with our clients, and you should do the same. Start with your investment options. As you can see, there are quite a number of options that might be available to you. There are stocks and bonds. Those are individual investments. There are mutual funds and exchange-traded funds or ETFs. Those are more diversified vehicles. The exchange-traded funds tend to have lower fees and be a bit more tax efficient. There's separate accounts and direct indexing strategies. Those are strategies in which managers are buying individual stocks or bonds on your behalf. They tend to have higher minimums, but they do offer tax loss harvesting. There are structured products and buffered ETFs. Those are strategies that use derivative investments to attempt to try to reduce risk or enhance returns. Again, there are a lot of risks there, so be mindful of those risks. There are private credit strategies in which managers are buying private debt on your behalf to get you or try to get you enhanced income. Private equity managers are using their expertise to get private equity investments for you, more specialized investments. They tend to be a lot more illiquid than some of these other strategies. There are hedge fund managers that are looking to enhance return, possibly reduce risk, using their special expertise. The fees tend to be higher on those managers, and they also offer less liquidity in some of these other strategies. And there's also real estate strategies. And you can consider any number of these options, but be mindful of the risks, be mindful of liquidity, and certainly be mindful of the managers that you purchase. Consider building a diversified portfolio. So we know in 2024, that was a year in which large cap growth technology companies did especially well, especially a small subset of the market. And it's definitely tempting to put a lot of money in those sectors since they're doing well. But what happens if investment performance changes? We recommend diversified portfolios for our clients. You should consider the same. Monitor your investments. So be mindful of your investments. How much do you have in any one country, any sector? Revisit that on a regular basis. Be mindful of your risk tolerance. I'll share a slide on risk tolerance in a couple of minutes. Be aware of emotional investing and the impact of being out of the markets, even for a few days. I'll share a slide in a couple of minutes. And I'll also share a slide on the efficient frontier, which is a set of portfolios that provide the highest return per level of risk. That's very important as well. And again, we consider all of these items in our work with our clients. Let's move on to risk tolerance. So risk tolerance is essentially the amount of risk you're looking to take in a portfolio. Risk tolerance is very important. We consider in our work with our clients because we want to do our best to keep them invested. Now, your risk tolerance is a function of two things: your ability to tolerate risk, and that's really going to be determined by your time horizon, the amount of income that you need from the portfolio, maybe the amount of cash you need from the portfolio, and then your willingness. That's more of your psychological makeup. So those two functions make up your risk tolerance. Be mindful of your risk tolerance, and we consider this in our work with our clients because we want to keep them invested in a portfolio that's suitable for them. Speaking of risk tolerance, here's a set amount of portfolios. We're looking at returns from 1926 to 2022. There's 11 portfolios ranging from the most conservative on the left side, that green, where it says 100% bonds, 0% stocks, to the most aggressive on the right, 0% bonds, 100% stocks. And let's look at an example, the 60-40 portfolio. That number in the middle, that's 7.6%. That's the average return over that time period. Now, your portfolio is not going to mimic this exactly. This is a portfolio that's using market indices, so be mindful of that. But you can look, you can see here, the highest return for 1 year for that portfolio is 27.9%, but the lowest return was 18.4%. So be mindful of these numbers as you construct your portfolio, or maybe when you're looking at your portfolio as well. And we do the same in our work with our clients. Be mindful of the efficient frontier. The efficient frontier is a set of portfolios that provide the highest projected return per level of risk. And let's take a look at an example here. This is a sample client, not a real client. The client's current portfolio is represented by that red plus. That current projected risk is 13.35%, and its standard deviation is the definition of risk here. The projected return is 6.08%. Well, there might be a way to tweak this portfolio to reduce the risk to 9.63% and increase the return to 6.75% and get the portfolio to the efficient frontier. That's represented by that green diamond. Now, many portfolios might not be able to make that switch because of things such as capital gains, but you should at least be mindful of the efficient frontier. We work with our clients. We really do our best to get their portfolios on the efficient frontier. Emotional investing. This is a very powerful chart. This is one of the reasons why we recommend clients stay invested and why we do our best to construct a portfolio that's going to keep them invested. Now, this is the S&P 500 over the past 25 years. And you can see here, if you look at the top of that chart, the total return per year is 7.67%. Well, if you missed 10 of the best days and you were invested in this index, wouldn't have been possible for the most part, probably, but your projected return would be reduced to 4.36%. And what does that do to you or do for you? Well, look at those ending portfolio values. Fully invested, the portfolio ends up with a value of $634,000. Missing the 10 best days produces a portfolio that has an ending value of a little over $290,000. It's a very powerful figure. As you can see here, it really makes a big difference. So be mindful of this and do your best to stay invested. Market timing is difficult, if not impossible. And we do our best to produce goals-based portfolios for our clients. It's going to keep them invested. Let's move on to tax planning strategies to implement before and after retirement. So you should be mindful of different tax strategies that are available for you. I'll share a couple of examples. When we work with our clients, we do our best to coordinate taxes and everything we do in our work with them. You should do the same. Now, here are some of the tax planning items we consider in our work with our clients, and you should do the same. Start with your tax rates. When we work with our clients, we have software that can help them determine certain strategies to use by looking at their tax returns, but be mindful of your marginal tax rate, your effective tax rate. That might help you determine which types of investments to use, municipal bonds versus corporate bonds, traditional 401k versus Roth 401ks. Does it make sense to do Roth conversions, things like that? Be mindful of the types of accounts. There are taxable accounts, there are tax deferred accounts, such as the 401k. There's tax-free accounts, such as the Roth 401k. I'll share some strategies for taxable accounts. I'll share some retirement strategies, some advanced options, and other items to consider now. Be mindful of your asset location. Asset location is simply being aware of where you place different types of investments. So most people have taxable accounts and tax advantage accounts. The taxable account is like a brokerage account. Tax advantage account is an IRA or a Roth IRA or something similar to that. I still see from time to time prospects who come in and they might have municipal bonds and IRA type of accounts, which doesn't make sense to me, but be mindful of that. So for example, in your taxable account, consider holding individual stocks that you plan to hold for more than 1 year. If you do sell them, they're going to get taxed at the capital gains rate, which is a rate that's lower than the short-term or ordinary income rate. And you could do the same for your tax managed stock funds, your index funds, anything that gives you a capital gains type of rate or has low turnover. And do the same with municipal bonds. Municipal bonds, for the most part, are exempt from federal taxes, so you could put those in your taxable accounts as well. In your tax advantage accounts, well, there you can put your individual stocks that you plan to trade. If you do sell them, you're going to pay a short-term rate, but since they're in a tax advantage account, you're not going to typically pay a tax rate on that, or you won't pay any tax on that. And do the same with your actively managed funds and your taxable bond funds. Anything that's tax inefficient, you can put in an IRA or a Roth IRA, but be mindful of that. And we do the same in our work with our clients. Consider tax loss harvesting. Tax loss harvesting is simply the act of selling stocks at a loss to offset capital gains or maybe some ordinary income, a set amount of ordinary income on a regular basis. And we do this in our work with our clients. So let's take a look at two examples here without and with tax loss harvesting. Let's say you own two ETFs. ETF A has a value of $60,000. I'm looking at the top left. ETF B has a value of $40,000. Let's say ETF A has an unrealized loss of $7,000, meaning you haven't done anything, but ETF B has a realized gain of $10,000. So you sold ETF B. Without tax loss harvesting, you're going to have that realized gain of $10,000. And let's say your tax or your capital gain rate is 15%. You multiply that $10,000. Now you have a $1,500 tax bill. Now let's say you harvest, in example number 2, you harvest that loss in ETF A. Now your realized capital gain is $3,000 because you offset the gain from ETF B with the loss of ETF A, and your new realized gain is $3,000. Multiply that by 15%. Now your new tax bill is $450. So you just saved that difference. In example number 1, without harvesting, your tax bill was $1,500. Example number 2, your tax bill is $450. Now that's a gain of $1,050. Again, be mindful of the rules here. There's a lot of rules, so this can be complex. Please reach out to me or reach out to your accountant if you have any questions. Here are some of the advanced strategies we consider and I work with our clients. You could consider the same. There are a lot of rules for each of these strategies, so please be mindful of those rules. Reach out to your accountant if you have any questions. Start with the 529, a Roth IRA rollover. If you have an unused 529, thanks to the Secure 2.0 Act, there is a way to roll over part or all of that 529 to a Roth IRA. Again, be mindful of the rules and limits. If you have a high deductible healthcare plan at work, consider a health savings account. A health savings account provides triple tax benefits. Contributions are tax deductible, earnings grow tax-free, and qualified withdrawals are not taxed. A donor advised fund is a very easy way to make charitable contributions. You can make contributions of cash or stock. You can recommend grants to eligible charities. There's a lot of strategies that are involved there. Be mindful of that. But a donor advised fund is definitely a very popular option these days. If you have an IRA and you're over 70 and a half, there are limits. However, you can move part of that RMD or distribution to a qualified charity and avoid the tax on that distribution directly to yourself. Some of the advanced options for high earners include the backdoor Roth IRA. Backdoor Roth IRA essentially is you're funding a non-deductible regular IRA, then you're making a Roth conversion. At work, if you have the option, you can fund an after-tax 401k and do a mega backdoor Roth IRA. Those strategies are complex, so please be mindful of that and reach out to your accountant. And also a Roth conversion. If you have a regular IRA, you can make annual Roth conversions. Again, be mindful of the tax rules involved there as well. Let's move on to estate planning. You're never too young to have an estate plan. I still see a lot of prospective clients that I meet that don't have estate plans, so be mindful of that. There are providers that we work with that can provide very simple trust and estate plans, and we're talking simple trust accounts, but be mindful of that. But let's talk about estate planning a bit. Now, here are some of the estate planning items we consider in our work with our clients, and you should do the same. Start with your estate planning documents. Everyone should at least have a will and or a irrevocable trust. That'll allow you to have a plan for distribution of your assets. If you want to avoid probate, consider a revocable trust. Be mindful of the gift and estate tax. Most people won't actually pay a tax, but if you're giving a gift to someone of unequal value in life or upon your death, there isn't a gift and estate tax. Be mindful if you have a state estate tax. Here in New York, for example, we have a state estate tax. If you have a large estate, there are irrevocable trusts that you can use. Consider picking up my book where I list a couple of strategies such as the spousal lifetime access trust, the grantor retained annuity trust, or the irrevocable life insurance trust. If you have a large estate, there are gifting options to reduce the value of that estate over time. So you can make gifts of $18,000 in 2024 or $19,000 in 2025 to an unlimited amount of individuals. You can split that gift with your spouse. You can give gifts of education, paying someone's tuition, paying someone's medical bills. You can be mindful of the rules there as well, but it's a nice way to reduce your estate over time without having to file a gift tax return. Have a plan for your wealth transfer and make sure you have plenty of insurance. We have a number of insurance providers that we work with. If you have beneficiaries, be mindful of who they are and make sure you educate them. Make sure they're responsible and they know how to manage wealth. And then be mindful of your beneficiary planning. I'm still seeing a lot of prospective clients that come in that they have IRAs and they're not really properly planned in regards to their beneficiaries. So be mindful of who those beneficiaries are. Here are some of the estate planning fundamentals we consider in our work with our clients. As I mentioned earlier, consider having a trust and or will. Be mindful of how your accounts are titled. Make sure that the titling of your accounts aligns with your trust or your will. Have a living will, which is a set of instructions you leave in the event you become incapacitated. Consider having a trusted person to serve as your power of attorney. Consider a financial power of attorney and a healthcare power of attorney as well. And as I mentioned earlier, be mindful of your beneficiary reviews. If you have an IRA or an insurance and you have someone named as a remainderment, that money is going to go to that person, not to someone mentioned in your will. So be mindful of that. Review that on an annual basis. Here's a sample estate calculation. This is a sample plan from eMoney. This is not an actual client. If you have a large estate, be mindful of how much your estate tax might be, especially if you're living in a state that has its own separate estate tax. Be mindful of that. Let's move on to lifestyle management, how to live your best life in retirement. Here are some of the lifestyle management items you might want to consider. Start with how you spend your time. So one of my favorite clients says he lives life as if he's still in high school. He has social studies, he has gym, he has a finance class in which he speaks with me. Be mindful of that. Be mindful of your activities, what are you currently doing now, and what could you continue to do upon retirement. Consider working and volunteering to keep the mind healthy, keep the body healthy as well. Make sure you stay connected. Here in the US, there is a loneliness issue, so be mindful of that and stay connected with friends and family. Be mindful of healthcare. Have a plan for healthcare costs, which can be increasingly expensive. So most people are eligible for Medicare at the age of 65, but if you retire earlier, be mindful of that. Maybe you could consider COBRA or consider your spouse's employer healthcare plan as well, if that's an option as well. If you are taking Medicare or when you decide to take Medicare, be mindful of the premiums. And I work with our clients. We speak with them about their Medicare premiums as well. Have a plan for long-term care. There are hybrid long-term care policies that provide you with long-term care. If you don't use long-term care, that ends up becoming an insurance policy. So we work with a number of providers that provide long-term care hybrid policies as well. That's the end of the presentation. As I mentioned earlier, please feel free to reach out to me if you have any questions. You can email me at louis.green@savvyadvisors.com. You can call or text me at 917-590-0552 if you'd like a copy of the book. go ahead and navigate to 5stepstoretirement.com/ebook or email me for a copy of the book. Thank you for attending the webinar. I hope everyone has a great day.